Welcome back. So we are now into the um, third week of the course Introduction to Commercial Banking and FinTech, and I hope you are enjoying it. The in this particular lecture, we'll be focusing on the art of making monetary policy, which is about the monetary policy rule, the policy that we see, the announcement of the repo rate and other variables. How do we decide the policy rate? So that will be the objective of understanding in this lecture. Uh, Globally, there has been trend that most of the central banks follow certain path of interest rate change, and the objective of the monetary policy is the price stabilization, of course, but also that there should not be any haphazard or very high rise in interest rates. So whenever you see a monetary policy announcement, you might be noticing that the RBI goes for maximum increase of you can say a rate of interest or the repo rate by 0.5%. So is it gradual, whether it is smoothing, what kind of stands we see. The second aspect is about why we have to understand about the monetary policy rule. So the idea behind this is that given the macroeconomic structure that the economy is facing at that point of time, can we predict the RBI's the possibility of changing the rate of interest? There are different agents in the economy. We know you have financial market, there you have the debt market, then you have the different equity segments, then we have the forex market, then we have the normal banking level borrowers, and also the lenders. Everyone has expectations about the future rate of interest. So given the rule that we are going to discuss, is there a possibility that given the macroeconomic condition, one can tell that the future path of the monetary policy look like this, right? In the communication, when we discussed about the forward guidance, right? So forward guidance is basically you are guiding for some directions that you may be taking the measures for high interest rate, but it is not exactly the same. It may happen that they may be you may be taking a different route. So this is what is the gist. So far we have covered mostly the economy side. In this class also we'll be touching upon those angles and try to understand. So let's understand what is Taylor rule. So John B. Taylor in 1933 came up with a very interesting idea that given the rate of interest, given the inflation rate, given the equilibrium rate of interest and output gap, can we predict the nominal rate of interest? So this was the idea behind. And when it came in 1993, there was no such rule, so it became quite popular. But over a period of time, we saw that this particular idea got augmented with a lot of, I would say, fillers. For example, financial stability, inflation augmentations. There are different types of inflation based nominal rate predictions and output gap based nominal rate predictions. But the John B. Taylor idea remained, and is still it is considered as one of the important tools to measure the monetary policy stance. But over a period of time, it is not exactly, we cannot 100% say that all the central bank globally they follow this rule, but it has some nuances and some credibility that makes the Taylor rule relevance even today. So let's understand the basic structure of the Taylor rule. So first is that here we have the nominal policy rate, right? So for example, in India, let's take the case of India's economy, that RBI is going to change the rate of interest. Take the decision on the policy rate. So here we have the repo rate. Then here we have the neutral real rate interest rate. So real interest rate, we know that the nominal interest rate, which is I, minus the inflation, so this becomes real. But what is the neutral or natural, which means that at this point there will not be any kind of unemployment. So your so this here yt is nothing but yt minus yt bar, right? So this is what output gap. So it means that this is 0, this is 0, right? So it becomes all 0, and then here we have what? So which means that the at this r star that we are going to have, we are having pi t minus pi star 0. So if we have pi star is equal to pi t, it means that we are meeting the target rate, which is the pi star is the target rate, right? And if it is equivalent to the current interest rate, for example, if the target rate is 4% and current interest rate is also 4%, so this becomes 0. So overall expression becomes 0. And yt is the output gap. I think in the last session I discussed about that. So output gap. So output gap is what? It is the actual output minus potential output, which means that given the labor and capital, how much you can produce. So as I mentioned that in the last session, I guess I discussed this. So yt bar, that given the labor and capital, how many goods you can produce, right? So yt bar is about that. So let's go here. So given the, let me clear this part. So given the, so here we have a yt is equal to the given labor and capital, how many goods we can produce, right? So which means that if the economy, suppose India has the capacity to produce only 1000 units, right? And the and it is actually having demand of only 1000 units, right? It means that 1000 minus 1000, so this becomes 0. So what we are getting, it is equal to r star plus pi t, right? And if I solve r star, what we are getting is nothing but, here we have it minus pi t. This is what we call it as a neutral rate, which means that there is no disequilibrium in the economy. So if we are, for example, let me spend 1 minute time on this output gap, why it is important. So we are saying that yt is equal to yt bar. What happens when yt is greater than yt bar? In this case, we what we call it as the overheating scenario. Which means that we are having more demand than supply. And if you think in terms of Phillips curve, which shows inverse relationship between inflation and unemployment, then in this case, what is going to happen? If yt is greater than yt bar, your inflation will go up because we are having overheating kind of scenario. As a result, there will be more hiring of there will be more labor demand. And I'm talking about, it should not be so high. It is not the stagflation kind of, or so here we are saying that a mild inflation. So let's target that it is having 4% target for the RBI. It is 6% or 7%, right? So there will be more hiring, right? So as a result, what is going to, so this, so all the companies will increase the capex because there will be catching up process. They will try to meet this demand which is rising. So as a result, you see a leftward shift. So this unemployment will be lower because inflation is higher. As I mentioned, it is showing inverse relationship. It is having downward slope. So it will be shrinking. You will have less unemployment. So this is unemployment. This is inflation, right? So here we have less. So this is good for the economy. But if you are having YT less than YT bar, then it means that it is having a deflationary trend in the economy. Now, if you are having YT bar, then it is called deflationary trend in the economy. Then it means that you will find that everywhere there will be, so you have here, it means that you have a high inventory. Banks will also find it low demand for borrowing because company will be simply postponing, the capex will be lower, so companies will be simply postponing the investment because they don't see demand in the market. They already have high inventory. As a result, your your Phillips curve will shift rightward. So we have inflation also going up, and also and then here we will have the unemployment also going up. Unemployment will be much higher than the inflation kind of scenario, and this is how we often mention. So in most of the scenario, you find that output gap becomes very crucial. Second thing is about the actual inflation. So actual inflation given the target. So for example, in India after 2016, we have MPC based monetary policy which emphasizes on 4 plus minus 2%, right? So this is the target rate, target or desired inflation rate. So this is the target for the RBI. And these parameters that you see, theta pi and theta y, these are the responsiveness of policy rate to inflation gap. So basically, you can say that in this particular equation, one that we are talking about, here we have inflation gap, and here we have the output gap. So all this, so whether how much should be the value of this? Should it be 1? Should it be 0.5? Should it be 0? What value you assume? So based on that, so in most of the practical cases, we find that theta pi and theta y is considered as only the 0.5 value is the normal scenario for most of the time, right? So let's move to the next. So let's take the case of India. So in India, as I have mentioned, that we have adopted flexible inflation targeting, right, in 2016, and there is a monetary policy committee that looks after price stability and growth. Suppose we are just assuming that, and here just assuming that the theta pi and theta y, which is some kind of unbounded, like you cannot just keep between 0 and 1, it can take any value because this is based on just regression. You can also run the regression and find out. So this is unbounded. This is also one of the demerits of this particular model. So if we have theta pi is equal to 1.5 and theta y is equal to 0.5, then the, and given these numbers that we are having, that neutral real rate is, suppose it appears to be 1.5%, current inflation is 6% if we are assuming, and inflation target is suppose 4%, output gap we see negative. What is the meaning of negative output gap? Negative output gap implies that YT is less than YT bar, right? So here we have demand of 150, right? And output that you can produce is 150 and demand is only 100. So 100 minus 150 is the minus 50 that you are saying. So 0.5% we have calculated in terms of, suppose in terms of GDP growth. So this is like you can calculate through, so output gap you can calculate through some filters, right? I think I explained this in class. So you can take into account the GDP data actual, you can take the nominal GDP, right, and here you can apply, extract the trend of this GDP. If you are having quarterly GDP data, then you can go for, if you are having quarterly GDP data, then you can go for GDP is equal to, so GDP of quarter 4, right, minus, you can also go for GDP of quarter 4 of last year upon GDP of quarter 4 of last year, which means that you will be using 3 observations, and then you can calculate. Or you can also go for GDP quarter 1 minus the previous year GDP quarter 1 upon the previous year of GDP quarter 1, and then you take the percentage. It appears that the GDP growth is YT, right, and then you can calculate. So this is basically a trend. So suppose trend appears to be around 5.5%, right. So 6 minus 5.5%, so it will show positive of 0.5%. But it can also be of negative, that you got the nominal GDP 5% and your trend is 5.5, right, which is YT bar, and this is YT. So 5 minus 5.5% is nothing but minus 0.5%, right. So this is what we get. And the response parameter is theta pi is equal to 1.5 and theta pi is equal to 0.5, right. So this is what we get. Now if you substitute this particular value in this, so these values that I have put here, if you substitute that here, right, in this case, then what you get is, here we have a nominal, so this is the formula that we have, and this you can also write YT minus YT bar. So 1.5 that I have got, all these values that you keep, your nominal interest rate given the actual inflation of 6%, right, your nominal interest rate must be 10.5% if the inflation rate is 6%, right. So this is what we get here, that given the current inflation of 6%, it is not a forecasted. You can see we do not have T plus 1 here. It is just that we are saying that given the inflation gap, given the output gap, given the natural rate of interest or neutral rate of interest and the current inflation, how much we can see the increase or decrease in the nominal interest rate. What we are saying is that if the current inflation rate is 6%, your policy rate must be 10.25%, which means that if the target is 4% and your inflation is 2% ahead than the target, because target is 4% here, you can see, right. So the spread is of 2%, right. In order to get this 2% into 2% under control, that it should not spread to 3%, your nominal interest rate should be 10.25%. And why we are also doing it? Because your output gap is negative, so recommended. So you can, if you are working with any fund management company or any economic think tank, and if you have been given the task to at least let's look at the nominal interest rate given the inflation gap and the output gap, then we can recommend that the central bank, if it is having the 10% of the rate of interest as of now, then it must be taking measures increasing the interest rate by 0.25%. So this is what here we can think about. I'll be also showing you that why for the central bank, even though we have a very well structured monetary policy rule, when we look at from the aggregate demand, aggregate supply side, RBI, we find that they are not able to meet this target anytime, and this is one of the demerits of and why we say that the policy inertia that we say, it is always a case. It is not so easy that, or it is not so mechanical that 1 plus 1 is equal to 2. It may happen that it can be negative, it can be 3 or 4, right? So this is what we say. Now people started questioning that when we are going to put a, a Taylor rule to predict the to calculate the nominal rate of interest, can we also take into account the previous period rate of interest, right? So they have gone for some kind of interest rate smoothing kind of scenario, and smoothing parameter here is rho, right? Now if you see the extreme bound cases, suppose I assume that a rho is equal to 1, right? If the rho is equal to 1, so 1 minus 1 is 0. So I am saying that if a rho is equal to 1, so 1 minus 1 is 0, the whole expression becomes 0, right? And and so, and if it is rho is equal to 1, it means that one can, if rho is equal to 1, it means that one can easily predict the rate of interest, because it is just equivalent to I t minus 1 plus the error term that here we have, right? And rho varies between 0 to 1. So the idea behind this is that given the rho value, if I am taking the extreme value of 1, then my nominal interest rate is same as the previous period rate of interest, which means that anyone can predict. But in real life, this is not the case, and it is not so easy. Let's look at rho is equal to 0. If we are going for rho is equal to 0, then what we are seeing that this becomes 0, and 1 minus 0 is 1. So it means that your nominal interest rate is equivalent to this Taylor rule plus this error term, right? Maybe the supply or any kind of shock. Now, so lower bound, it is leading to the Taylor rule. Your nominal interest rate is equivalent to Taylor rule plus the shock. But in most of the cases, what we find is that when we have the rho is equal to 1, then it is just the adaptive expectation, right? Which means that my today's based on today's value, I can predict the future, right? So this is what we say. But why we see that the higher values are not higher value of rho is not encouraged, because it means that you are just taking a very strong stance that may not be the good, and it may impact the other markets like financial exchange rate and others. Let's understand with one example that how it works. So here we can see that, suppose I assume that my IT is equal to rho IT minus 1, and then here we have the 1 minus rho IT hat, which is nothing but the Taylor rule based, right? So IT hat is the Taylor rule. Now if we are going to put the value here, that what is going to be, then we can easily see, for example, I will come back to this slide. Let's go about this particular case. Suppose the target interest rate based on the inflation output is 7%, and the current repo rate is 6.5%, right? So the target is 7% based on the Taylor rule, and the current repo rate or the inflation on the is just 6.5%. So if rho is equal to 0, as you can put here the value, if rho is equal to 0, right? So I am just having my nominal interest rate is just as this same, right? Which means that I can go on putting this as 0 into 7% plus 1 minus 0 into 7%, what we are finding, right? What is the value that we have? It is same, right? No, it is 6.5. Okay, fine. So it is 6.5. Let's delete this. So here it is 0 into 6.5. So this becomes 0. So what we get is your nominal interest rate will be equivalent to 7%. Right? So this is what we get. Now here you can see, so IT is 7%. So IT is equal to IT hat is 7% here. Now you can say that if you are seeing no smoothing, rho is equal to 0, the rate of interest will shoot up immediately 0.5 basis point. It will be a big jump, and this creates the trouble, because this will have the sudden impact on the market, and market may not be able to digest. If it doesn't digest, then this creates the trouble. But if you are assuming that rho is equal to 0.8, what appears that you multiply 0.8 into 6.5 plus 0.2, because 1 minus rho here we have. So here we have 7%. So what comes out that it is just 6.60%. So even though the target interest rate is 7% based on the Taylor rule, my previous repo rate is 6.5%. Given the rho value of 0.8, we are seeing that we have to just increase based on the previous value by 0.1, 10 basis point increase, not 50 basis point increase when rho is equal to 0. So what is the learning here? Learning here is that if the rho values are higher but not exactly 1, then I see gradual increase in the rate of interest, even though the target is higher, right? Target, suppose for example, even though the difference is of 8%, 1% or 0.5%, RBI will not be taking the measures immediately of by the same magnitude. It will be taking less than that. So here you have something called gradual adjustment in the economy, right? And this is what, so it is not called monetary policy surprise kind of thing, right? So this is what reducing the shock to financial market and the real economy, because this, if you are increasing by 10 basis point as compared to 50 basis point, 10 basis point is more rational and easier to digest as compared to others. So I hope with this background you are able to understand the monetary policy rule, and we'll be also discussing different types of rules in the next session. So I'm stopping it here. Thank you so much for your attention. I appreciate it.